Good afternoon. My name is David Ruffin. I am principal of IntelliCredit. I wanted to welcome you to today's webinar for Holtmeyer and Monson and IntelliCredit on 2022 loan growth, both finding it and managing the risk, the two age-old balancing act issues that bankers always live with, growth and the risk associated with it. I am absolutely delighted today to be joined by arguably the greatest expert in the country on government guaranteed lending, Arne Monson, and he, I believe, has been designated by ICBA, for example, for what I believe, Arne, 16 straight years as the SBA preferred service provider.
Yes.
And again, no one brings any more expertise to a key part of what we're going to talk about in terms of the source of loan growth today than Arne. So again, thank you again. We did this gig, I believe, about a year ago. So that was very, very good. I'm also, as my mug would probably indicate, have been around a little bit, even though we are the newest division of the Quick Rate family of products and services, which, as you know, is renowned for providing community financial institutions with practical and affordable solutions, both products and services. What we'd like to do today is to talk a little bit about the challenges that continue to dominate our industry in terms of uncertainties and challenges that have lipped over from the COVID. And it does appear that we just can't seem to shake the effects of this pandemic at some level. But we would like to talk a little bit about what we're facing in terms of that. And of course, a lot of that is, as the title would imply, growth. The Armageddon that was certainly feared in the March and April of 2020 just simply did not materialize. We certainly know that. There are a lot of temptations to claim victory in our industry as a result of that. But as you remember, the old renowned radio and television broadcaster Paul Harvey used to pivot kind of halfway through his homily of the day and always say, well, here's the rest of the story, or the other side of the story. We all have to be intellectually honest and recognize that through the huge amount of government largesse and the PPP program in specific, and the regulatory respite that was given largely in 2020, a lot of this has really accrued to the benefit of banking financial performance. We still are, and I think Arne would agree with me on this, we are still living in an environment where a lot of people, irrespective of the business press coming from Wall Street, they live on Main Street, and survival remains a key part of what is still unfolding out there in Main Street. There is irony, I think, with the PPP debt, for example, and that is what I call the taint of traditional debt. Think about it. If you're out there borrowing money for a year or a little more in such a way that you didn't have to repay it, it's hard to get back in a mindset of thinking, oh my goodness, I have to actually repay this loan. There's also this continued risk, current rate compression that makes loan pricing a huge challenge. I was with a couple of CEO peer groups within the last 2 weeks where they said, yeah, I could grow my loans very easily, but I'm not going to give it away. And what we're finding is there's tremendous amount of concern about putting longer term loans out there with such thin pricing. I think also in the last particular month or so, there's been heightened concern clearly of where short-term supply chain inflation, how indeed short-term that is. Is it in for the long haul? Because if it is, then that has all sorts of implications for repayment capacity, particularly in the consumer and mortgage areas, I think. And as the title would imply, much of our industry is in negative loan growth, and it does beg the question of where is that growth going to come from? Specifically, and this is indicative, I think, of the numbers through our sister division, Quick Analytics, based on third quarter call report data, shows the industry inclusive of PPPs is being down. Some states vary. Some states are actually in some positive. The good news there, as you see in the kind of asterisk below, is if you net out the PPPs, there is some ray of sunshine in terms of some positive loan growth. However, as of third quarter, we've still estimated almost $60 billion of PPP loans yet to roll off bank balance sheets. But even more strategically or fundamentally, I think the Fed data out of the St. Louis Fed was even kind of warning about some potential negative momentum in lending activity or lending loan growth prior to the COVID, as the chart to the right would indicate. So changes are afoot in lending that we as bankers have to accept and frankly factor in as part of our challenge. I would argue the economy is going through perhaps the greatest churn since the advent of the internet itself, particularly, again, dealing with the impact of COVID on ferreting out winners and losers, particularly in delivery of goods and services all across the economy. Some of these, of course, even preceded COVID in terms of the digital revolution of online shopping and so forth. Office space may be in the throes of a change of a permanent paradigm. Inventory and housing is totally different from where we were a dozen years ago in the financial crisis, where frankly, the taint of speculative lending has kept bankers on the sidelines in certain dynamic markets where supply and demand are just really out of kilter. Small colleges and universities, nonprofits have suffered to some degree because unwittingly, perhaps, of the Tax Reform Act of 2017, which basically de-incentivized some of the charitable giving. Remember, that's top line revenue for nonprofits. Restaurants and hospitality, of course, are the usual, rather usual suspects that we are concerned about with COVID. Again, one of the terms that I think is very interesting from a good friend and a client in California is he talks to his business pipeline team every week about, is it Amazonable? Which in other words, is it something we've got to face in terms of it on the internet? Is it becoming is that part of our competition that we have to face? And I think it's true among most bankers that no one really believes these credit metrics will last into the next 2 or 3 years, particularly as we get beyond COVID and have to kind of ferret out where some of the the non-government largesse impact on our portfolios may start bubbling up. Some of the regional and community bank credit metrics we're going to look at today, again, from our sister division, Quick Analytics. This is based on regional banks under $10 billion. If you look on the, the simpler way to look at it is the inventory of problems, which is non-performing loans to the left. If you look at that, you're basically looking at the Western region states have the lowest inventory. Everyone's got relatively low inventory of problems. Again, it's about as benign as I've seen in my long career. Charge-offs are inconsequential. Again, the Western states have less charge-offs. And then if you look at the traditional way of looking at reserves to loans, you look at and see that the West has arguably 159 basis points. A variant of that is the West is covering their acknowledged problems, which are very low, over 3 to 1. Now, an objective party, and maybe this doesn't sound normal coming from a credit guy like me, could look at these numbers and say, well, given the fact that we've got a lot more capital than we did in the last financial crisis, and with these reserves, and we're still concerned about loan growth, somewhere in these numbers would indicate that we've got some ability to take a little more risk in growing loan portfolios. Again, it's just what the numbers would certainly imply at this point. Certainly, this is dominating not so much loan quality, but this whole issue of where the yields are. Some of the states, frankly, are upside down. In other words, their yields are lower than the national average. Their cost of funds are greater than the national average. The whole industry, of course, is dealing with compressed NIMs and have been now for a couple of years. Wholesale funding is not an issue because of the flush of liquidity. And again, being seen here depicted in relatively in relative terms from recent memory, the lowest loan to deposit ratios we've seen in the industry in years and years and years. Again, largely from this induced liquidity of government program and PPP and so forth. So it does beg the question of how do we grow loans smartly? Um, and I would say that that's one of the issues that we're facing in an aggregate or macro way from the banking segment is we're having to accept that if you split this U.S. economy down the middle, we're now approaching only lending to half of the borrowing needs. If you add up all of the other non-commercial banks, which would be the credit unions, the insurance companies, the private equity groups, the venture capitalists, the any other entity that's actually lending money to people needing money, they're now approaching 50%. That's even shown in this American Banker article in October, showing business lending is now roughly 50-50 between commercial banks and in terms of C&I, commercial banks and the quote rest of the lending universe. So 5 areas that I've spent some time and written some articles on, excuse me, is to explore participations from reliable sources. There's been a huge, almost a cottage industry developed with a lot of the correspondent banking banks and even state associations looking at ways to network participations from more robust urban areas of their states to more rural areas where there doesn't seem to be a lot of natural loan demand. That's certainly one, I think, objective and legitimate strategy to embrace. One also might look at strategically accepting the fact that, particularly for a community bank, that kind of giving up, at least on the margins of being all things to all people, is a valid strategy. The numbers don't lie. Some of the highest performing community banks in the last few years have come from banks that are arguably niche banks or have established a certain area of targeted lending that they have become expert in. Perhaps the most controversial thing I'll say today is to consider different types of lending that may either appeal to different alternative lifestyles or in some cases areas that you may not feel comfortable with. I feel like I can say this because I am a baby boomer, but the reality is the industry is moving on from just baby boomer values. The younger people are demanding things in terms of the technological needs for them to be using banking and lending and depositing that some of us older people are not as comfortable with. But I think that applies to all other types of lending that you might consider. But if you do so, of course, make sure you've gone through the proper diligence and understanding of what you're taking on. One just alluded to this a moment ago, and that was, of course, the fact that 1 to 4 family housing is upside down in some dynamic markets. I'm speaking to you today from Raleigh, and that there's very little inventory of mid-tier housing in Raleigh, largely because, again, the people are moving in and there's very little inventory. That's created a huge artificial bubble of sellers market, and it's created problems that I think hopefully the regulators will give a little leeway in terms of bankers getting out there and financing some more inventory in these dynamic growth markets. And finally, and usually, frankly, I usually lead with this slide, and that is, for goodness sakes, shred any reluctance you may have ever had about embracing SBA, USDA, and other government guaranteed lending programs. The biggest sink, before I hand it over to the real expert in this, the real reason I feel so strongly about it is there are 3 things. One, it certainly gives you loan growth. Secondly, it gives you fee income. And thirdly, from a credit guy, it gives you potentially a credit mitigant. And when you go down the road in a year or two, and you're facing a regulatory scrutiny about why did you lend to this entity or that, if you've got that government guarantee in place and it's got efficacy, then you've protected yourself from potential criticism about taking too much risk in that. With that being said, I would like to hand it over to, again, Mr. Monson, the great expert in SBA lending, and Arne is yours.
Thank you very much, David. Expert, that's a dangerous word, but I'll take that as a compliment. So some of you may be familiar with our firm. I looked at the roster and I saw some familiar names in there. So Hello to all of you, and greetings from Memphis, Tennessee, where I am. USDA and SBA loan programs are more critical now, I think, than ever for several reasons. We have a large client base, and we're finding that a lot of small community banks were never involved with SBA or USDA lending. It just wasn't part of their product offering. And then PPP came along, and they were either incentivized or forced to get into that activity, and found it to be, not a nightmare necessarily, given the travails of E-Tran. I understand that, but anyway, it was a positive experience. And now they're rethinking their strategy that, maybe this government guaranteed lending is something that we should be offering in our product mix. So uh, there is extra stress on small businesses through the pandemic. We work with a broad variety of clients nationwide, so we see a large footprint. Companies that maybe were stressed during the pandemic, maybe they were shut down, maybe they had limited operations for a period of time, and that really put pressure on profitability, cash flow, and of course, the PPP funding was a band-aid, and that has served its purpose. But now we're coming out of that, and borrowers have unique needs after the PPP phenomenon. So access to capital is more critical now than ever. And how do we, as lenders, continue to provide access to capital in a prudent manner? So next slide, please. Uh, Mitigating risk. We're all in the risk business here. And to the extent that we can mitigate risk and make that a positive experience, that's something we should entertain. Uh, Government guaranteed lending, SBA and USDA, is a great way to do that. You have existing clients who, the phenomenon we see is they've been healthy historically and become conventional borrowers, traditional borrowers, where they didn't need that credit enhancement. Now, through the pandemic and the stress they've been through, maybe their equities eroded, maybe they've lost some customer base, and so they have digressed, if that's the right word, to the point where they really require that credit enhancement to have you provide credit to them. So the SBA, the Small Business Administration, and the U.S. Department of Agriculture offer a wide variety of programs, which we are heavily involved in, and primarily loan guarantees. And those serve to mitigate risk. So it allows you to extend access to capital to borrowers that you could not do on a conventional basis. And there are more of them now. Credit enhancements, again, are offered through those guarantees. So if your credit box has either shrunk or been adjusted or modified, and you find yourself with some what we call marginal declines, someone that might fall just outside of your credit box, how do you accommodate that borrower? Maybe they historically have been credit worthy. Now they've got a couple of warts, and the government guaranteed programs are ones that will allow you to continue to serve them. Next slide. Uh, so why are community banks getting involved in this? Several reasons. Uh, First of all, government guaranteed lending is specialty lending. It's a little bit technical. You have to know what you're doing, and there are some resources that can aid you with that. So USDA and the SBA, again, we're heavily involved in the legislative process of those agencies, and they are very well funded now. We are operating under a continuing resolution presently, but funding has been assured and it's been continuous. Some of us on the call may remember times when SBA and USDA ran out of money mid-year. Well, that hasn't happened for a few years, and we intend that that won't happen. So if you have lenders that are maybe have had very little, no experience with USDA lending, but they got involved in PPP. Now they're rethinking their strategy. One way to get involved with that is to use the services of a lender service provider. Holtmeyer and Monson happen to be the president and owner. We're the largest lender service provider in the country. So affiliation with a qualified lender service provider, and there's been some news lately about certain lender service providers that weren't qualified and are now suffering the consequences of that. But this allows you to get into the government guaranteed lending business without a lot of sunk costs or overhead. If you staff up, develop a department for government guaranteed lending, and the volume doesn't generate, then you're stuck with some sunk costs, and that might turn to be a bad experience. But another thing, the SBA and USDA guarantees are very valuable instruments in the secondary market. And there's a very vibrant, healthy secondary market that buys individual guarantees and compiles them into homogeneous pools. About an hour ago in our office here, we sold an SBA guarantee for 117% of par, 117.7, 17 points of premium. So those are very profitable operations for community banks. So next slide, please. So activity levels, just to give you some historical background, the 7A program, which is the largest, most widely used SBA program, next guaranteed program, in the last fiscal year just ended in September, provided $36 billion in loan guarantees to creditworthy borrowers. That equates to 51,000 small business borrowers that took advantage of SBA guaranteed loan programs. That represents a 20% increase in the number of transactions and 61% increase in dollar volume. So if you do the math, not only is usage up, but the size of the transactions is increasing as well. So these programs do work, and with the right mentality and the right risk profile, it can be very profitable and good activity for community banks. So as I mentioned earlier, we're under a continuing resolution. It was just kicked down the politicians kicked the can down the road, as they say. So I think it's funded until about the middle of February, and let's hope by then we have a permanent budget in place. I can tell you this from personal experience, if you back up just 1 second there, the SBA programs as well as USDA are very well received in Washington. The politicians embrace these. It is a cabinet position, which several years ago was not. Small business owners, they create employment, they create wealth, they pay taxes, and they vote. So that's why these programs work and are well received by the political class in Washington. Next slide. So to give you a high level view of the programs that are primary to the SBA, I mentioned the 7A program. That's the guaranteed program. Your lending institution makes a direct commercial term loan to a creditworthy borrower, and upon that, you get a percentage full faith and credit government guarantee. So these guarantee percentages range from 75 to 85%. They are amortizing term loans, and you can extend that maturity, thus taking pressure off cash flow, thus improving the vibrancy and health of the small business borrower. Presently, there is a guarantee fee waiver on any SBA loan of $350,000 or less. The SBA continues to operate at what's called a zero subsidy, which means it charges user fees, guarantee fees to fund its operations and potential losses. The small loans, as they describe them, under $350,000 have a waiver on that guarantee fee and the ongoing servicing fee. The Express program, and some of you may be familiar with this, sub-program of the 7A program, it presently has a $500,000 maximum gross loan amount, has a reduced guarantee of 50% rather than the aforementioned 75 to 85%. The difference here is that the lender is granted delegated authority to make credit decisions unilaterally. So it's, as we say, the lender holds the pen here. This credit facility can also be used as a line of credit, whereas the 7A is strictly for term credit facilities. So those are the primary programs. We're heavily engaged in all of them. The USDA program, historically it's been called B&I, Business and Industry. Recently they rebranded a group of consolidated programs under what's called RD1. same program. It's a risk-sharing program. Government guarantees are issued. The maximum gross loan amount here is $25 million. So it has a higher maximum gross loan limit, different usage, 80% full faith and credit guarantee, as opposed to the other guarantee profiles I mentioned for 7A. These maturities can go out as far as 30 years. In our practice, we see the usage of this for a wide variety of ag-related facilities, chicken production, turkey production, hog production, dairy, grain handling facilities. These make for excellent USDA, BNI, or RD1 programs. Interestingly, the USDA program can be used in addition to the SBA program. So if you run across a borrower that has used up their SBA eligibility and they're really looking for a credit enhancement, consider the USDA. It can be used in addition to the 7A program features. Next slide. So how do you from the banker's desk on Main Street, how do you identify some good, viable government guaranteed loan transactions? And again, this is specialty lending. It's a little more technical than conventional lending. It has a little different risk profile, and it has a certain strata of borrowers that still are not conventional borrowers but are creditworthy. So I'll cite some examples we see in our practice. And in an average year in our offices, we complete about 1,000 government guaranteed transactions. So business acquisition transactions. Someone's buying or selling a business. The buyer is generally buying some goodwill with that business acquisition. The SBA calls that enterprise value. It is heavily skewed towards cash flow. It has a lot of value, but it has no collateral value. So how do you, as a banker, lender, get comfortable financing an intangible asset? Well, with an SBA guarantee to support that credit facility, mitigate the risk, that's a logical solution. Business reorganizations, we see a lot of this where through the pandemic, some businesses may have shrunk in size, may have had discontinued operations, maybe doing some other reorganization, and they need capital to finish those projects. So reorganization of existing business is a good possibility. So as you're meeting with customers looking for loan growth, keep these items in mind. Franchises, special purpose businesses, service industries, those are uniquely qualified for SBA and government guaranteed lending because again, you have shortage of collateral. Sometimes you have second career people that get into a franchise operation, so they're new to the industry, new to the business operation. Permanent working capital financing is a key. Although PPP did provide a good shot of working capital to these borrowers through the pandemic, if that's been used up or absorbed into the business and now they're experiencing a growth spurt, they need some permanent working capital. Very tough to finance that conventionally, but with that SBA or USDA guarantee, makes it viable. Debt restructuring. This bullet point here is much misunderstood. There have been times in the past when the SBA in particular limited its growth by limiting or eliminating the ability to restructure debt, refinance debt with an SBA loan. Presently, you as a lender can refinance another institution's debt as you're out prospecting new clients. You can also refinance and restructure what's called same institution debt, your own institution's debt, so you can give the borrower more favorable terms. And one thing we see in our practice all the time is those conventional lines of credit that have gone evergreen, and they really should be termed out, and your borrower needs new working capital access. So a strategy that we embrace a lot with our clients is take those evergreen lines of credit, conventional lines of credit, put them on a 10-year term with an SBA guarantee. You include some new permanent working capital, so there's a good shot of cash into those transactions, and force that borrower to make some principal reduction, and maybe you establish a new conventional revolving line of credit for them. So those are some things to look for. When we do staff training for client banks, we talk about, where can you find loan growth, where can you find prospects? these are some excellent opportunities that you may not always be thinking about. So next slide. Benefits to the lenders. The SBA, of course, is a program that benefits primarily borrowers through the issuance of those guarantees. But we've found, and we've been heavily involved in task forces and advisor capacities. The SBA, those of you that are golfers, really kind of gave the industry a mulligan for the year of 2020. When we look at underwriting and we do a spread, historical cash flows, projected cash flows, you can kind of skip over 2020 because it was such an unusual outlier of a year. So if you have assumptions as to how you're going to regain your borrower's financial health, you can have that one bump in the road that year 2020 presented. Knowledge of these changes and these dynamics is critical. Again, if you have an in-house department that's staffed up and has some expertise, that's great. If you don't, where can you find that expertise? A qualified lender service provider. Extended term permanent financing that is not available conventionally. That's one of the beauties of these programs. And again, extending that maturity takes pressure off cash flow, takes pressure off equity, and is a good tool for both borrowers and lenders. Next slide. So wait and see, not a good strategy. Your small business borrowers, existing and new, they need that access to capital now. Borrowers are familiar, those that have gone through the PPP experience, there's a natural aversion to dealing with a government guaranteed program. You have to follow a protocol, you have to deal with the government, you have to do some extra work, maybe you have to pay some fees. But we found that really is secondary to, again, access to capital. And if the borrower had a positive experience with a PPP loan, and now they need some permanent financing, it's a natural transition. Your lending team needs to have these solutions ready to offer. Believe me, I travel a lot around the country. I was in Baltimore yesterday with 2 new clients. Your competitors, your competition is making SBA and USDA loans. So if you're not, you're missing on a certain market segment. Those of us that are community lenders, and we're all in that business, we're relationship lenders, not necessarily transaction lenders. And there's competition that, is transaction lenders. And that's okay until you have a need, until you have a problem, until you have a unique circumstance where you need that relationship with your banker. So this is a good way to develop. We have run across a lot of clients that through the PPP process did not necessarily limit PPP lending just to their customers. They reached out in their footprint to non-customers, and now they're circling back to them and making them customers, making them new relationships for their institution. So don't wait. It's the clock is running, and those borrowers, they're looking for capital, they need it, and if they don't find it where you can provide it to them, they'll use some of the other sources available. Next slide.
Yep. Thank you, Arne. I appreciate that. And that last point you made, I think that it's very clear that the benefits to from a public relations standpoint, particularly the community banks, has been really stellar over the activity and aggressiveness by which the community banks stepped up to do aggressive PPP lending. And we hear that all over the country. So take advantage of that. I was remiss in at the beginning of the broadcast in encouraging you to take advantage as participants in either the chat or the Q&A options that you may see on your screen to give us any questions or comments, and we'll review those at the end of the broadcast, which is coming up just in a moment. And now, of course, for the so-called other side of the story, the classic check and balance that banking is all about, and that is, yes, growth, but how do you manage the risk associated with that growth? That's the ever-present, again, conundrum that bankers tend to live with and have to. So we'll like to talk about some of that in the closing moments of the presentation today, and that is starting out with, I was asked to participate in an article at the recent Bank Director Conference in Chicago, interviewed by a journalist, and they said that, and a regulator was part of that as well. Regulator was saying by far the biggest concern in the regulatory community right now is complacency. Complacency largely over the stellar numbers that continue to come out of banking from a quality standpoint, over the presumption that yes, there still may be some shakeout ahead for us in the next couple of years around the net effect of the COVID pandemic, that particularly as government largesse kind of fades beyond the scene. Excuse me. So I would certainly encourage for all of these initiatives, particularly SBA, USDA, as Arne clearly shows his expertise and experience in that. But don't do it if you're not prepared to retain lending talent, ensure the efficacy of your risk protocols to correspond to these either new initiatives or more aggressive initiatives to enhance loan growth. And most importantly, remember the effect and efficiency of technology at all levels. There are arguably 6,000 fintech companies trying to do business with commercial banks these days, but there's a lot of companies that are already proven that they can give you affordable, practical solutions to enhance your efficiencies, and particularly as it relates to managing and overseeing the risk potential for any of these growth initiatives we've been talking about. I do think philosophically, I've said this many times over the years, be sure as bankers that you recognize that all loans get over the all loans are good loans until they're bad loans, which is really basically depicting kind of that public-private data divide between call report and your own idiosyncratic data. We all know that the real art of managing credit risk is in the early detection of credit deterioration, which is well before it becomes publicly identified in a call report. Look for red flags from both public and non-public data. And I think over what is proven over the years to me as a credit guy is that the biggest single factor in predicting or identifying credit risk in your portfolio is really how does the market, in a general sense, value the commodity, if you will. That's a broad definition of the term commodity, but in other words, the products and services of your borrowing customer, how the market treats that is really the single biggest factor of that. It really does have huge impact on the supply and demand, revenue margins, repayment capacity, and of course, ultimately collateral value. We're big believers that one of the more futuristic approaches in managing credit risk going forward is really a need to sync three critical input factors leading to management of a bank or even to a board level of a bank. And that is doing what we can to take three different disciplines, stress testing, portfolio analytics, and loan review, and put more energy into trying to make sure that they inform one another a little more as opposed to being totally separate and devoid of each other in terms of input. I use this only to emphasize what's over to the right, and that is remember your peers, your regulators, unless they're in the throes of an exam of you, and certainly your investor class, tend to see your bank through the eyes of public data. Again, it's the idiosyncratic non-public data that gives you the first insight into where emerging credit risk. Utilize that. Take advantage of all the tools and products that are out there that give you that insight, because that is, I think, going to be critically important to companion with potentially some more aggressive loan growth that you might be taking. Fundamental benefits of portfolio analytics can be summarized in three primary areas. One is stay on top of the risk, understand the difference between macro and aggregate and transactional credit risk. They're very different disciplines, but they need to be seen in harmony and understood in harmony. Debt service coverage is not probability of default, loss given default. The latter is very statistical. disciplines that have to be applied. That's not traditional credit analysis. Probably the most vexing aspect of COVID for maybe 2 or 3 years to come would be the middle slide, and that is know your credit hotspots, know where your portfolio areas are that may be at variance or anomalous to the overriding macro performance of your portfolio, and dig into those, understand and be ahead of the curve in terms of risk in that regard. And this is a pitch for the technology and the efficiency. Many of, and we're certainly dedicated to this at IntelliCredit, is give the C-suite and even the board members the ability to point and click and drill down without having to delegate to an Excel power user or some data engineer to come up with reports a day or two later. That really is the advent of where technology is taking risk management these days. We certainly are big advocates of that at IntelliCredit. A perfect example of what I said earlier about subsets. Here's an example on the left of the portfolio at large, year to year, showing absolutely no migration of the classic bell curve statistics. But if you look at a subset, in this particular case, residential construction, there's been a little bit of a shift to the right, indicating all within past categories, by the way, not public, past criticized classifieds in residential construction that would merit perhaps some heightened attention at this particular bank. But using that kind of mindset is going to be critically important, I think, as we begin to track the effect of potential more loan growth or the residual effects ultimately of where COVID leads us. Loan review. Traditionally, loan review is still yet another intrusive, inefficient form of another examination. We at IntelliCredit have been dedicated to try to remove some of that, remove some of the intrusiveness and the kind of blind meetings and so forth that are distracting of management, and create a lot more of a real-time effect on report writing, clearing exceptions, all of which in effect gives you your ability to do your day job and treat loan review more as a concurrent event as opposed to shutting down and having to deal with them almost like examiners from the regulatory agencies. A couple of 3 things I'd like to talk about in terms of our best practices. Please, we're big advocates of having seasoned credit officers or credit reviewers do loan review. Ask all of your vendors that you're taking bids on for loan review to provide bios of who is going to be performing. Just having frankly, a CPA degree right out of college may give you the ability to do the kind of a quantitative quality assessment of credit, but not the qualitative, which usually is experientially based. There's another piece of this that is news from the new guidance, and that is you're frankly not allowed from the regulatory standpoint to just bypass large problem or substandard credits anymore from independent assessment. That was a common practice prior to the last issuance of the interagency guidance. Regulators now would like to see any materially problem credit reviewed also for its workout plan by independent eyes. And as you see, thirdly, which is the next to the last line item on this best practice, is if indeed you embrace SBA, USDA loan growth as a strategy for growing your loans, which we obviously believe in on this presentation, make sure that periodically you have your loan files and even your processes, your internal processes, reviewed by experts that know and can give you consulting advice, or make sure that that's an investment in maintaining the efficacy of those very important guarantees. And again, technology we think is very clear to be embraced. So the stress testing. Here's the conundrum that faces all community bankers, because you're not prescribed to do it, but everything we're hearing from bank leadership these days is that regulators who've been effectively back in the saddle, now doing more standardized examinations, are telling their banks, community banks, that they would like to see some form of a stress test applied to at least certain segments of the portfolio. The conundrum is that it does, without it being prescribed, none of you on this call, I'm sure, are DFAST or CCAR level banks, and therefore you're not prescribed to do it. But again, it's now under the expectation level of the regulators. I'll be very brief in terms of academics on this. There are two basic kinds of stress tests. One is a top-down that's largely informed by public data at the portfolio level that can be determined and gleaned from your call report. The other is so-called bottom-up or loan level stress testing, which is really only determined through getting at your idiosyncratic non-public data. We're big advocates of companioning those two. But that's the most basic difference between, and again, we're hearing it more and more that is expected. A third, however, which we think is very practical, is perhaps companion a stress test, a targeted stress test concurrent with a loan review engagement. And what specifically that means is, let's say a loan review is 250 loans in the sample, 30 of which may be identified as CRE loans or commercial real estate loans. The loan reviewer, during again, concurrent to the loan review itself, can use certain, in this example here, certain variables such as debt service coverage or loan to value metrics, stress those, and then extrapolate at the conclusion of the loan review what that might, at least theoretically, do to risk-based capital at your bank. That's not a very complex stress test, of course, but again, remember the benefit for community banks is it's without it being prescribed, it is in the eye of the beholder. And this approach has been certainly approved and addressed by some of the regulators, is certainly sufficient for some of the non-complex community banks. So why would you companion it with loan review? I think it does kill two birds with one stone. Arguably, loan review is one of the most real-time perspectives applied to a borrower's current circumstance. And it certainly can be another variant of the sensitivity analysis or projections, if you will, that you tend to apply at the original underwriting of the loan. And I do think, combined with traditional loan review reporting information, it would just be a huge value add for management, the board, and ultimately to see have presented to the regulators. Some key questions, of course, is do we have access to the credit metrics we need? I'm a big advocate of you need to be telling your own story. A legitimate question, as I talked about early on in the presentation today, was given the capital, given the more reserves you have, are you willing to take any more credit risk to grow your loan portfolio? Again, maybe sounds like heresy coming from a credit guy, but I do think that part of the challenge in our industry right now is growing loans. We can't, that's the primary source of good, solid income, long-term income for the banking industry is not in the securities portfolio, it's in the loan portfolio. And if you so choose to be a little more aggressive in growing your loan portfolio, have you got adequate portfolio analytics? Have you got good, effective loan review? And have you got some stress testing going on? Because that inevitably is going to be asked of you in probably the next round of examinations. So staying vigilant, I think, is really is where we need to be. And, again, you decide after proper due diligence what alternative paths to grow loans need to be. Nobody's advising you to make snap decisions or knee-jerk reactions. All of these are going to require some kind of proper diligence around whether or not it meets your risk appetite or it's the type of lending you really want to go into, and you've got the resources to deliver that. I alluded to this a minute ago, and that is you always want to be seen as captain of your own ship, writing your own script, never appear to be a deer in the headlights with a regulator, not kind of understanding where it is going on. Most of them come in your bank, frankly, with a bit of a proxy on what your risk profile looks like. Sometimes that's accurate, sometimes it's not. And it's up to you to disabuse them if it's inaccurate. Nothing in my long career has been more toxic between management and a board or a bank and the regulatory community than too many credit surprises. It conjures up one of two awful things. One, it's either a competency issue or lack of transparency, neither of which are trait you'd want to be attached with. Again, part of the benefit of early detection of credit risk or deteriorating credit is it obviously empirically proven that it reduces losses ultimately, but it also may give you that flexibility to move that credit out of the bank before it's dead. And as you know, once it becomes typically publicly acknowledged as a criticized classified, as they say, that loan's yours. You're stuck with it. And I do think, given all the uncertainties we've alluded to today, this more insight into your risk management and the things that we're talking about would certainly help into that, and also give you the justification for embracing these loan growth opportunities. So Arne, I'm going to give it back to you one more time to just maybe summarize a couple of things that you'd like on this screen, and I'll close it up.
Sure. Thank you very much again, David. As we prepared this, we decided that each of us would have about 2 minutes of shameless promotion. So here comes the shameless promotion. Tell you a little bit about our company for those of you that aren't familiar. We are the largest lender service provider in the country. We're serving over 400 community banks. We've been at it since 1982, so I was 12 years old when we started the company. We are an outsourced alternative to an in-house SBA, a government guaranteed department. So if you're not sure of your volume, if you're new to the industry, if you're new to the lending profile, it's cost prohibitive to add a lot of people and staff up and take on overhead when you can outsource it and control your costs. And the italicized print there with no net cost to the bank, we can show you how you can get into this business with no net cost to the bank. We've been around since 1982, good long time. As David mentioned earlier, we've been endorsed by the ICBA as a preferred service provider since 2006. That's a pretty big deal. That's a very meaningful endorsement. We manage bank SBA and USDA portfolios, loan portfolios. We're presently managing about $3.5 billion of SBA and USDA portfolio loans. We're also very involved with NAGL, National Association of Government Guaranteed Lenders. So if you have some continued interest, my contact information is available. I'll be delighted to have a conversation with you. So thank you.
Arne, before I let you go, there is one question from the audience that is clearly for you. And that is, I'm hearing that SBA may provide direct loans to borrowers up to $150,000. Is that correct?
There is a proposal going through the Congress, and actually it's included in the Build Back Better, the big spending bill. I personally, and we as lender service providers, dearly hope that doesn't happen. Every time the SBA has had a direct lending program in the past, it has been an abject failure. That's not an overstatement. Plus, it's a lost opportunity for us community bankers. Your borrower could get a direct loan from the SBA, and then you would be a stranger to that transaction. So it doesn't work. It hasn't worked in the past. I gave an interview to the American Banker a while ago, and I asked the question, who's going to service that $150,000 SBA loan if the borrower needs a deferment or a collateral release or a reamortization or some unique aspect? That should be handled at the bank level and the government. We are really pushing hard to have that struck from that massive spending bill, and we hope not. So I think not. I believe we're going to be successful in avoiding that case.
Before I summarize my pitch, there is a question that's probably related to me. In fact, I know it is. It says, do you have examples of regulatory actions of recent feedback related to your complacency comment? Well, I do. And this came from a CEO directly in the Midwest. And he said a couple of weeks ago, he said, this was the worst situation in 15 years. The regulators forced him to put a very large substandard loan into non-accrual because, quote, the regulator felt that the bank had abused the regulatory respite afforded the bank in 2020. In other words, the bank apparently had used some liberalized extensions and modifications deep into 2021, and the regulator basically blew whistle or dropped a flag and said, you've abused the, and of course, that's was quite impactful to that bank. Again, we're hearing all sorts of issues that regulators are afraid of complacency, are afraid that people are buying into all this stellar, benign credit metrics, that's going to last forever. So I do think that is a legitimate, specific example of that. Okay, I don't believe I see any others. I did one other, Arne. Do you expect a fee waiver on SBA loans under the 350 to become permanent?
I personally think not. It's legislated through the end of the current fiscal year, which would be September of 2022. After that time, I think these incentives are good and helpful, but when they then get removed, then there's lots of anguish and crying. So I believe it'll sunset at the end of the current fiscal year, and then the agency should be able to get back to a more normal operation. So I think not. I'm not a politician, but our position, as well as others in the industry, is that's a good incentive for now, but let's get back to normal operations.
All right. Well, thank the audience very much for the very good questions. Just very briefly on kind of our pitch as far as IntelliCredit is concerned. We offer a cloud-based tool that has both a portfolio analyzer, a portfolio analytic tool, and the loan review on the same platform. They inform each other, but also we certainly offer using that platform loan review in the more traditional third-party vendor outsource. There's another piece of this that some banks can use it as a hybrid between internal loan review and external. Some banks are using it strictly for internal in-house loan review only. And surprisingly, perhaps mostly, is that we are agnostic to other loan review vendors that use it for their own loan review practice, because they've seen the efficiency. And again, what I alluded to earlier, the less intrusive nature of loan review, using kind of a fintech product with traditional quality review work and disciplines. So again, it is web-based. It is also SOC 2 compliant. So certainly would love to talk to you about that in the future. And again, we thank you for the Q&A, and here Holtmeyer and Monson, as well as IntelliCredit's contact information is here. We particularly want to thank you very much for the valuable time you've spent with us today. Wish you the best on the holidays as we approach the year end. And again, thank you so much for attending today.
Thank you.